I want to go over optimal position sizing. In this setup, we see 53 strategies in our portfolio setup. Max drawdown is 23,000. This is right at 24,000. The number that I really want to focus on is the max, the total profit over drawdown. Right here you see 75.01, and you've got 53 strategies trading one futures contract. These are E-mini. All the stock indexes trade E-minis, and then the other markets such as gold, silver, crude oil, RBOB, soybeans just trades one futures contract. And so what would be the optimal position sizing? What can we do to increase the total profit over drawdown? This is the number to look at if you want to scale more quickly. How much is your drawdown? How much is your profit? The more your profit goes up to your drawdown, the lower your account size will be. If you can increase this number, you can scale more quickly. You can add more contracts more quickly. And so currently this portfolio setup takes $163,000 to trade 53 future strategies with one contract each on the E-minis and then one full contract on the other markets that are not stock index markets. And so I want to increase this number, total profit over drawdown. So what I've found, if I quickly take a look at this, what if I trade 0.3 of this strategy? 0.3 is 3 micros instead of minis. And so you're trading 3 micro contracts instead of one E-mini, and 1 micro is 1/10 of an E-mini. So if you trade 3 micros, then it's 0.3 on the contracts. In the past I had this as an integer, now I have it as a decimal number, so you can use micros, do the calculation with micros. So if you trade 53 strategies, now this number right here sums up this, so it's summing up the fractions. I need to change the formula for this to a count if formula, and so this is still 53 systems, but it's summing up the decimals, so it's still 53 strategies. This number is 10,658. So you see 10,658. You've improved it from 75.01, and then you've got 30. You've got over 30 E-mini S&P and E-mini NASDAQ strategies trading right here, and so that is the bulk of this portfolio. And you have less of each of the other markets. For example, you see some gold strategies here. There's 3 gold strategies, a silver strategy, a crude oil strategy, soybeans, gold, silver, crude oil, RBOB, soybeans, crude, gold, natural gas, gold. And so up here you have a long list of NQ and ES strategies right here. So you have 33 strategies right here that trade NQ and ES, and so there's a disproportionate number of systems in this sector as related to, for example, gold, silver, crude oil, soybeans. And so if you decrease the number of contracts, then your ratio of strategies per sector is more even, I guess you could say, is an easy way to say that. And so you really boost this. You could also, one of the things I also looked at is taking crude oil. There's quite a few crude oil strategies. So what if we traded a half of a contract on crude oil, the QM contract? I don't really like trading QM, so I don't really recommend doing that. So I'm gonna have to modify this. Hang on. So I've fixed that here. So now let's take a look. I'm going to have to manually type this in because it's not copying and pasting correctly. 0.5 for this, and then let's see, 0.5 for these. And I'm going to explain this further here in a minute. This is an approximate number because if you trade QM, it trades in 0.25 instead of 0.1. And so you could find the lowest common denominator for these, and I'll show you how to do that, but you'd have to have a lot more capital. But the return over drawdown would still be the same. So now this really improves the return over drawdown a little bit further, 10,889. So it's more incremental. It's not as big of a gain as going from 75.01, went from 75.01 to 10,600% and to the 10,800% when we add a half a crude oil, where drawdown is less than 10K. So less than 10K drawdown on 53 strategies. We're trading micros, 3 micros on these stock indexes, and half a crude oil contract, and your drawdown is less than 10K. So what is the lowest common denominator? If you don't want to trade QM, this would be, I would just trade one contract of crude oil and go with the 10,669% or whatever it was. I can't remember the exact number. Or if you have more capital, see, this requires only 85K, and I would say you could even, since all of these strategies don't take a net position, you could probably even trade this with 50K. That would be aggressive. You would be covered on your drawdown would be 10K. You have to cover that, and then your margin is 75K. And so, if your drawdown is 10K, if your worst case drawdown is 10K, and you're aggressive, and you say 2/3 of the strategy will only ever take a net position, so that's 50K plus 10K is about 60K. So if you went with 40K, if you put 40K for margin and 10K for drawdown, you could trade with 50K. That would be aggressive. You would just be saying about half the strategies only take a net position at any given time, which is typically the case, but it's still an aggressive approach. So 1089 with this setup, I would go back and just trade one CL on this instead of trading the QM on these half contracts. And now if you wanted to do the lowest common denominator and just trade minis and full contracts, you would have to have more capital. You have to go 3. I'm just going to copy this all the way down. So all the stock indexes, you trade 3 contracts, and then you would trade 10 contracts on the others. I'm just going to copy this all the way down. So if you didn't want to trade the micros, you'd trade 3 and 10. Your capital required would be about $1 million. Your worst case drawdown would be about 113,000. You have that 10,658. Once again, the same ratios we had before. We're not 1069, it's 10,658. The number of strategies is still 53. This is really the number of full contracts, not the number of strategies. So 299 contracts, and so that's one way to take a look at it. You could also break this down further. You could trade 5 crude oils instead of trading the QMs. Now you're able to find the lowest common denominator of full contracts, and then go in here and all the CLs, put in 5. And this is just a quick analysis that I did. It does not necessarily resemble the absolute optimal total profit over drawdown. You could actually run an Excel calculation to find that. I have not done that yet. What you could do is you could run an Excel. Excel has a method for running calculations where you can run the scenarios for each of these so that this is maximized. And so you get 10,889 trading 3 minis on all the stock indexes. You're trading 10 contracts on all the others except crude oil, where you're trading 5. And so this would require 856K, and you could probably trade it with less, like we talked about before. Trading it with 500,000 would be very, very aggressive. But here are the results. Nice total net profits, and I like the drawdown curve. Nice drawdown curve. Very quick recoveries. I like how quick these recoveries are, and very cyclical in nature. Total profit 558, 863, 734, 803. And as we've talked about before, we do expect degradation. So you have to allow for some degradation, but these are some nice numbers to start with if you have the capitalization to trade this. And once again, you can trade 1/10 of this size with micros, 3 micros, and then 1 E-mini on these, and still get nice results, and then compound. as you move forward. So wanted to share that with you. Total profit over drawdown is a number to take a look at.